We have an expert in the room, Luke Laretive. Luke, welcome.
Bryce, Ren, let's dance.
And we have a listener on the phone who has submitted their portfolio for Luke to review and provide some feedback. On the line, we have Joe. Joe, how are you?
Yeah, pretty good.
Now, Ren, as always, do you want to take us through Joe's portfolio?
Yes. So Joe has quite a concentrated portfolio of individual stocks. We've got 8 companies. Pro Medicus is the largest holding at 40%. Then we've got the payments duopoly, MasterCard and Visa, coming in at 23 and 16%. Mercado Libre, the South American e-commerce player, at 12%. And then we've got some smaller holdings to round it out. LVMH, Intercontinental Exchange, Meta and Chipotle, all about 2 to 3% weightings in the portfolio. So Luke, 8 stock portfolio from Joe, all global shares bar Pro Medicus.
Quite interesting.
What's the nickname?
The nickname is filter sort ROE. So if you're on Excel and you put on the filter and then you go sort and then you sort by largest to smallest ROE, that's what I feel like young Joe's done here, and just build his portfolio by looking for the highest return on equity companies around the world that he can find. Is that correct, Joe?
Well, sort of. Like the way this portfolio came about, basically you have to understand it, you have got to go all the way back to the GFC, because I bought some stocks during the GFC, 2 of which are like the OGs, as you would call them, which are MasterCard and Visa, as well as some other equities. And then around 2013-14, when I was finishing school, I sold some shares in TPG and a few other ones because the portfolio had accumulated quite a bit. And then because it was too big, we split it into 2 portfolios, and the other one, my mum sort of now handles that bit of it. And that's more like with an Australian focus, although it does have some global equities. And then the second one, which is the one you're probably looking at and is on the show, was because, I wasn't satisfied with Australia and I'm greedy and I want to buy, great shares all around the world, basically.
Okay.
Nice.
Well, if you bought Visa and MasterCard around the GFC, Visa's up about 2,000% from there, and MasterCard's up about 3,500% from there. So
But let's make the point
full
that
credit
matters for today,
Yeah.
which is not telling Joe how clever he is, but how dumb he is. Because the reality is that Visa and MasterCard are 89% correlated over the last 10 years and 91% correlated over the last 5 years. So they are effectively the same company, right? So they move together. Those returns are about as correlated as you can get for 2 stocks. So I would, not saying sell either, buy either, whatever. I'll just be thinking about it as 28% of my,
It's
30% of my
40,
portfolio.
yeah.
Well, it's actually 16% Visa, 23% MasterCard.
So what's
almost
that, 29,
40%.
40% of my portfolio is correlating together, right? So I'm always thinking about trying to generate returns from, diverse source of things that are kind of low correlated equities. It's hard to be negatively correlated, but you want lower correlations among stuff, all making you money at the same time, ideally, but for different reasons, if that kind of makes sense. Yeah. More idiosyncratic reasons. If we're going to pick stocks, we want to be picking stocks for idiosyncratic reasons, for unique reasons, nichey little things. So that's just something to keep in mind.
Yeah, so you can 35 bag a stock and Luke can still find a problem with it.
The question is what are you doing today with the money?
Yeah, I know.
That is the thing. Like, well done, you've got money. Heaps of people do. Congratulations, let's go. The point is what can you do today to make more, and how can you ensure that you're outperforming in the future? And from my perspective, I'm always thinking about, not just outperforming in absolute numbers, but thinking about, risk and risk-adjusted returns. And I think when you're managing significant amounts of money, which sounds like this potentially could be, that's the kind of attitude you want to have. So I don't know about your mum's portfolio or whatever, not sure about that one, but you want to get, if you're going to run a high conviction portfolio, like 15 or 20 companies, like bare minimum. Bare minimum. And like 5 sectors, 4, 5, 6 sectors at least, like when I'm talking sectors, I'm talking about GICS sectors.
Yeah. For people that don't know what that means, you mean like
just type
materials, industrials, technology,
real estate, blah, blah,
retail,
blah, blah, blah. Yeah, correct. So
again, just diversification.
Yeah, basic diversification. Nothing wrong with running concentrated portfolios, but I didn't bother going and doing the, correlation covariance matrix for your whole portfolio, but I bet you it all would be really correlated.
So I think there's one aspect which is portfolio construction, which Luke is talking about here, And then we'll talk about the stock picks themselves, but
Yeah.
just holding on portfolio construction. When we said that Pro Medicus was 40% of the portfolio, I thought you'd jump in there, but you haven't. So
Well, I was waiting. I was
Okay.
waiting. I was like a snake in the grass.
so
So
talk to us about portfolio weightings.
yeah, okay. So for the punters at home, you need to just keep your stock, your biggest weighting in your portfolio, like 15%, 20% max. That's it. One company max. Even that just makes my eyes
Why
water.
though? Why?
Because you need to be properly diversified, and the best stock pickers in the world have 50, 55, 45% win rates. So
What if the best opportunity to do with your money though is to keep it in there? Like,
how do you know it's the best
No,
opportunity?
it's just
Are you so
the
certain?
risk. The risk is too high that you blow up.
The risk is that you're wrong.
large
That's the
percentage
risk.
of your portfolio, or even that you're
But-
right, but the market disagrees with you for too long.
Yeah. So look, the math don't lie here, right? Like let's say that your really good win rate, you're 55%, like your top win rate globally, 55%. You're still 45% chance that Pro Medicus is going to underperform. Now you might be right, you might be wrong, but the reality is that the math says that you shouldn't be so high conviction. So that's why.
Yeah,
That's why we do it. So is PME a good business? Yes. Is it trading on 200 times earnings? Yes.
No, it's actually trading on 350 times earnings according to Google.
Yeah, but that's because you're reading last year's earnings.
I know,
talking
it's just a bigger number.
I'm talking about forecast earnings. It's on 208.9
Forward earnings.
Yeah,
Yeah,
forward, 1 year forward, right? On the basis that they can continue to win market share in what the world sees as a global, increasingly addressable, growing addressable market. Market share wins do not go on forever. Margins do eventually cap out. They're already at 70%, just for for those playing at home. Growth eventually slows. Monopolies eventually either get regulated or get disrupted. It's inevitable. So it may not be tomorrow. It may not be next year. It may be in 10 years' time. I may be massively wrong about this, and this might grow faster than everybody expects. But I don't think I am. So we don't own Pro Medicus. I don't want to own it. Would I short it? Tempting, but I wouldn't.
But again, that's not because of the quality of the company. That's
Good
just
business.
because of the...
But a piece of bread, sourdough from the best baker in the world. It's only worth so much. One slice of bread, right?
I don't think we need the bread analogy to understand
But do you know
valuation.
what I mean? Like everything's got a price.
So we got a lot to cover here. So I just want to close out portfolio construction on the flip side. So
Yeah.
that was some of the bigger weightings, but Joe also has some smaller weightings, 2 and 3%.
Fine with that.
Are you fine with that? Yeah.
Yeah, I think theoretically, if you can make enough picks, and you can, one's fine. One's actually okay.
1%.
Especially like a starter weight. Like we do that sometimes. Like we like something, we want to do want to do more work on it, but we'll put it in at 1 or 2, and then but the goal is to get it to 3 or 4. And if we don't get it to then we'll sell it. We'll get rid of it altogether. If you it looks pretty good, but I'm not all the way home conviction yet. But I don't want to miss something, or I've got a catalyst that I want to get involved in, or whatever. Or I've got some lazy cash that I want to get back in the market. Like sometimes you'll just do a little starter position. So yeah, I don't mind the smaller weight stuff. It's more the 23s and the 16s and the 40s that give me heart palpitations, especially when they're 90% correlated to each other.
Nice. So Joe,
Yeah.
let's turn to some individual stocks. Are there any stocks in particular that you want to ask Luke about?
Well, Pro Medicus, I know, it brings back memories of Domino's, because I used to have that one, and I remember I sold that also. But the reason behind Visa and MasterCard I picked them is because I wasn't initially sure. I mean, this was going back when I was still in school, so I didn't know which one was going to work out so well. But the two that really sort of concern me are LVMH and Mercado Libre, because I'm not really sure, what your thoughts are on those two. Those were the ones I really want to know your opinion about.
As much as I would love to give you a view on those stocks, I've got a view, but at the end of the day, I know that I'm not an expert compared to every other analyst on the planet who covers those companies, right? So, I can give you a pretty red hot view on Pro Medicus. I can give you a pretty hot view on any other ASX listed company that's, notable. But it's really these days, I used to like, we've owned LVMH for clients back in the day when we used to do global equities direct, but these days I don't buy direct global equities for clients anymore. So we just buy managed funds for people, because there's specialists out there who are better at picking stocks than me. So as much as I would love to tell you that it's all going to turn around at LVMH and, you know, the luxury recession is going to turn around or whatever, like, yeah, maybe. I'm not sure. They're all good brands. They've all got historical good businesses. I think if you held them for long enough, you probably do fine. But
Yeah.
it's not. I don't really have a competitive edge on any of those companies.
Yeah, fair enough.
Sorry.
That was
Well, look, I think Luke started the conversation by giving it the nickname filter return on ROE. But, you know, one of the things that you're looking for in good companies are companies that can earn a high return on equity. So you're not too far away, Joe. But, you know, think about your portfolio construction, the portfolio weights. And if you find the next Visa or MasterCard that will 35 bag over 15
sounds like you've
years,
done well.
just shoot us a message, would you?
no worries. I would do my best.
Nice one, Joe. Well, we'll leave it there, but thank you so much for submitting your portfolio. I hope you managed to get a few things to think about from Luke there. We do really appreciate
Yeah,
it.
no worries.
Thanks, Joe.
Yeah.
Thanks,
Awesome.
Joe.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equities.